As of May 31st, 2024, the total AUM of the NPS or the National Pension System stood at about 11.8 lakh crore. Of this, central and state government NPS constituted a mammoth 9.3 lakh crore. That's almost 80% of the entire NPS corpus. Now, given these numbers, it wouldn't be wrong to say that the NPS AUM is dominated by central and state government NPS subscribers. In the past, when we prepared videos on the all-citizen model or voluntary NPS, we received many requests to prepare a video on the central and state government NPS. So, given our viewers' request and also the massive share of the central and state government NPS, we decided to dig deeper into this. Hello and welcome to ET Money's YouTube channel. Today, we are going to talk about central and state government NPS. We will discuss their features and performance. And so, if you are a subscriber of those, this video is going to be of enormous value to you. But if you are a subscriber to the voluntary or the all-citizen model of the NPS, this video is not for you, unless you are curious to know about the other models of the NPS. For such viewers, I have mentioned the links of our older NPS videos in the description. You can watch them instead. Now, I've divided this video into sections and I'll discuss central and state government NPS under each section. If you are interested in a particular aspect, you can jump to that section directly via the timestamp links mentioned in the description. And do share, like and comment on this video so that it reaches more and more viewers. If you aren't a subscriber yet, please subscribe to the channel and click on the bell icon so that you never miss a video from us. Alright, let's begin with a brief background to the NPS. The NPS was first introduced for central government employees except armed forces joining the services on or after January 1st, 2004. Subsequently, it was extended to state government employees too, with different states adopting the NPS on different dates. The all-citizen model of the NPS came into force in May 2009. It allowed any Indian citizen to invest in NPS for retirement. Finally, in December 2011, the corporate sector NPS was introduced. The central government NPS is also applicable for central autonomous bodies. Similarly, the state government NPS is also meant for union territories and state autonomous bodies. Now, in terms of types of accounts, the NPS offers two, Tier 1 and Tier 2. The Tier 1 account is the mandatory retirement account. Tier 2 is an optional investment account. Now, unlike the Tier 1 account, you can invest and withdraw from it anytime. You can even transfer funds from Tier 2 account to Tier 1 account via a mechanism called the one-way switch. True to its name, it doesn't allow transfer of funds from Tier 1 to the Tier 2 account. Now, we have discussed the NPS Tier 2 account in greater detail in one of our earlier videos. You can find its link in the description. PFRDA or Pension Fund Regulatory and Development Authority is the regulator of the NPS. The NPS has three KRAs or Central Record Keeping Agencies, Protean, CAMS and KFintech. They carry out the administrative and customer service functions of the NPS. The other entities involved in the NPS system are: Number 1, NPS Trust, which holds the pension assets of subscribers. Number 2 is Pension Funds, which manage the investments. Number 3, Nodal Officers, which act as an interface between subscribers and the CRA. Number 4, Annuity Service Providers are insurance companies that provide annuities to subscribers upon their exit. Alright, let's now look at the other features of the NPS for the central and state government sectors. Government employees can register in the NPS either online or offline. Online registration can be done through CRA websites. For instance, in case of Protean, one can visit their website and register oneself. Online registration is possible for state government employees only when the respective state government has enabled this option. Alternatively, one can fill up the subscriber registration form and submit it to the nodal office. It's available on CRA websites. Post-registration, a PRAN or Permanent Retirement Account Number is generated. A PRAN kit is sent to the subscriber either electronically or physically. A subscriber can track the progress and download the e-PRAN from the CRA website as well. So this is the standard procedure for registration. There can very well be variations depending on your organization. So do consult your company's HR for finer details. For government employees, NPS contribution has two components. First, the government contributes 14% of the salary plus DA to the Tier 1 account of NPS, which is the mandatory retirement account. And the second, the subscriber contributes 10% of the basic salary and DNS allowance to the Tier 1 account. Now, government subscribers can also make voluntary contributions to their Tier 1 or Tier 2 accounts through their CRA website or mobile application. The NPS also offers a DRemit or direct remittance facility. This facility allows you to get the same day NAV for your voluntary NPS contributions. You can even set up an SIP with DRemit. When you use DRemit, the funds are sent directly to the trustee bank, and this fastens the process, enabling you to get the same day NAV. Of course, you will have to first activate DRemit through the CRA website. This involves creating a virtual account ID and then adding it to your bank account as a beneficiary. Now, to set up an SIP, you will have to give a standing instruction to your bank to debit your account and send funds to the virtual account. Separate virtual IDs are needed for both Tier 1 and Tier 2 accounts. Finally, to get the same day NAV, you must send funds before 9:30 AM. Alternatively, contributions can be made through nodal offices and point of presence or POP branches. Central government NPS subscribers have three options to choose from, and there is one default option too, if they don't make a choice. The three options are Scheme G, Scheme LC50 and Scheme LC25. Scheme G invests 100% of the corpus in government bonds. Now, LC stands for Life Cycle Fund. Schemes LC50 and LC25 taper the subscriber's equity and corporate bond allocation as per their age. For instance, LC50 will have 50% equity, 30% corporate bonds and 20% government bonds for a 35-year-old. The equity allocation keeps decreasing by 2 percentage points every year until it becomes 10% at the age of 55. After that, it doesn't fall. The allocation to corporate bonds also keeps falling by 1 percentage point every year until it reaches 10% at the age of 55. And the allocation to government bonds keeps going up by 3 percentage points every year until it becomes 80% at the age of 55 years. Now, the idea behind this tapering is to reduce the allocation to riskier assets with age and consequently increase the allocation to safer assets. The LC25 scheme starts at 25% equity, 30% corporate bonds and 45% government bonds. At 55 years of age and onwards, it has just 5% equity and corporate bonds and as much as 90% government bonds. So LC50 is comparatively more aggressive than LC25 and hence is likely to be more rewarding too. Now, in the NPS terminology, LC50 and LC25 come under the auto choice as your asset allocation keeps changing automatically. Also, when you choose Scheme G or Scheme LC50 or Scheme LC25, you will have to choose fund managers for Scheme E, C and G. Now, there are 11 pension fund managers in NPS. So quite naturally, it's challenging to pick the right ones among them across the three asset classes, which is equity, corporate bonds and government bonds. But we have you covered. You can watch our NPS video on the best fund managers to find out where to invest across asset classes. You will have to choose only one fund manager for all the schemes. NPS also allows you to change your fund manager once a financial year. The investment scheme can be updated up to 2 times in a financial year. Now, as I told you earlier, if you don't choose any of the three options, which is Scheme G, Scheme LC50 and Scheme LC25, your corpus will be automatically allocated as per the default scheme. In the default scheme, your corpus is split equally between the central government schemes of 3 pension fund managers, SBI, LIC and UTI. By default, these central government schemes have 85% allocation to debt and 15% to equity. For instance, as of May 2024, the asset allocation of the central government scheme of SBI pension fund is on your screen. In terms of credit rating exposure of the debt portfolio, Just 0.20% is in AA and below AA rated bonds. So, in terms of credit quality, this is a highly robust debt portfolio. Alright, let's also now take a look at the returns of the central government schemes of the three fund managers, which is SBI, LIC and UTI. Now, across time frames, the returns of the three central government scheme fund managers have remained remarkably similar. Do know that in the default option, you can't choose the fund manager of the central government scheme. Your corpus is distributed across all the three schemes in an equal proportion. So, your choice is rather restricted with the default option. For state government employees, respective state governments have to allow the option to choose NPS schemes. If a state government doesn't do so, the allocation is made to the state government schemes of the NPS. These state government schemes also allocate about 85% to debt and 15% to equity. For instance, the asset allocation of the state government schemes of SBI Pension Fund is on your screen now. Returns wise also, these schemes don't have much difference and the return profile is like that of the central government schemes. The allocation to each of the fund managers of the state government schemes is determined by the respective state government. Now there are three scenarios when you can exit from NPS: normal exit, premature exit and upon the subscriber's death. Let's see them one by one. Normal exit from the NPS happens when the subscriber has reached the age of superannuation as per the applicable service rules. On attaining this age, you can withdraw the entire NPS corpus as a lump sum if it is less than 5 lakh. But if it is more than 5 lakh, you can withdraw 60% of the corpus as a lump sum. The remaining 40% must be used to buy an annuity. Now, there is no tax on the 60% lump sum withdrawal or on the 40% part that is to be used to buy an annuity. However, the annuity payouts are taxable as per your applicable slab rate. Now, the current list of annuity service providers is on your screen. Another case where the normal exit is possible is if the employer certifies that the subscriber has been discharged from the services on account of invalidation or disability or premature retirement as per the applicable service rules. Further, normal exit can happen in the case of a central government employee if the subscriber is discharged from the service on certain grounds as prescribed under CCS NPS Rules 2021. Next comes premature exit. Now, premature exit happens in the case of resignation, voluntary retirement, dismissal or removal by the government or employer prematurely. On premature exit, if the accumulated corpus is up to 2.5 lakh rupees, it can be withdrawn as a lump sum. But if the corpus is more than 2.5 lakh rupees, at least 80% of it must be used to buy an annuity. The subscriber can also transfer the corpus to the all citizen model of the NPS and continue to stay invested in the NPS system. In NPS, this is called inter-sector shifting and we will talk about this later in the video. Next is the exit on the death of the subscriber. Now, if the subscriber dies before the age of superannuation and if the accumulated corpus is up to 5 lakh, it can be paid as a lump sum. They can also offer annuity payout if they so desire. Now, if the corpus is more than 5 lakh, at least 80% must be used to buy an annuity for the dependent, that is spouse, mother and father. The balance 20% can be withdrawn as a lump sum by nominees or legal heirs. If the dependent family members are not alive, then the 80% annuity corpus can also be returned to the surviving children of the subscriber or the legal heirs. There is a limited clarity on the taxation on premature withdrawals and exit on the subscriber's death. While the annuity payouts will likely be taxable as per the slab rate of the recipients, it's not certain whether the lump sum payouts also attract tax. You can consult a tax advisor for more information on these. A subscriber can also make partial withdrawals from the NPS. For that, one must be an NPS subscriber for at least 3 years. There are a number of reasons for which partial withdrawals can be made. These include children's higher education, marriage of children, purchase or construction of residential house, specified illnesses and so on. There are 14 specific diseases covered for partial withdrawals. But do note that there can be maximum of 3 partial withdrawals from the NPS during the entire tenure of the NPS account. Now, the amount that you can withdraw is 25% of your own contribution. It doesn't include the employer's contribution. And it doesn't include the returns on your own contribution either. So you can withdraw just 25% of the principal corpus from your own contributions. Now, as far as taxation of partial withdrawals is concerned, they are tax-free. At the age of superannuation, if you don't want to withdraw your NPS corpus, you have two options: continue investing in the NPS and defer the withdrawal. Now, if you decide to defer the withdrawal, do know that you can't make fresh contributions to your NPS account. To avail either of these options, you need to raise a request 15 days prior to attaining the superannuation age. After that, you can continue to invest or defer your withdrawal until 75 years of age. Now, if you continue to invest, the account can be operated normally with all the facilities and features during this tenure. You will also be eligible for tax benefits from your NPS contributions. You can also exit from the NPS and start pension anytime during the period of continuation. If you choose to defer the withdrawal, there are multiple deferment options available like defer annuity or defer lump sum or defer both. Now, during the deferment period, the subscriber can exit the NPS anytime. Now, apart from continuation and deferment, one can also opt for systematic lump sum withdrawal or SLW facility of the NPS. It allows the withdrawal of the 60% lump sum corpus in tranches in place of a lump sum. Now, these withdrawals can be based on age or the amount of installment, and the frequency can be monthly, quarterly, half yearly or yearly. Your NPS contributions get tax benefits in three ways. First, under Section 80CC(d)(1), an employer's own contribution is eligible for tax deduction up to 10% of the basic salary and DA. This is within the overall 1.5 lakh limit of Section 80CCE. Second, the employer's contribution of up to 10% of basic plus DA is tax deductible under Section 80CC(d)(2). This rebate is over and above the 80CCE limit of 1.5 lakh. Third, employees can voluntarily invest up to 50,000 rupees in Tier 1 and claim tax deduction on it under Section 80CC(d)(1)(b). This deduction is also beyond the 80CCE limit of 1.5 lakh. So all in all, NPS does have some very attractive tax benefits. NPS Tier II Tax Saver Account or Tier II TTS is a special option available only for central government employees. The investments made in the account have a lock-in period of 3 years and they qualify for tax deduction up to overall limit of 1.5 lakh under Section 80CCE. The TTS account enables central government subscribers to choose a pension fund manager of their liking. They can even choose different fund managers for different asset classes. And as icing on the cake, different combinations of fund managers can be chosen for each contribution. Now, apart from Tier II TTS, central and state government employees also have the option to invest in Tier II default scheme. Like the Tier 1 default scheme, the Tier 2 default scheme allocates the corpus to the three fund managers, SBI, UTI and LIC. These fund managers allocate the assets in the proportion of 85-15 towards debt and equity, as in the case of Tier 1 default scheme. But unlike the Tier 1 default scheme, the Tier 2 default scheme offers no tax benefits and one can invest and withdraw from it anytime. The inter-sector shifting facility of the NPS allows you to port your PRAN number when you change jobs across sectors. This means you need not apply for a new PRAN when you change your job. For instance, if you switch your job from central to state government, you can transfer your existing PRAN to the new entity. Now, do know that if you are changing your job within the same sector, say for instance between two state governments, you don't have to go for inter-sector shifting. Your PRAN is automatically shifted within the same sector. Now, NPS has emerged as a promising investment option over the last few years, thanks to its good returns, low cost, diverse options, and tax benefits. From the government's perspective, the NPS is a crucial step towards shifting to a defined contribution model of pension from the defined benefit one, as the latter tends to strain the government's finances. With time, it's likely that more features and flexibility will be added to the NPS, which will further help improve its value quotient. Since the NPS is mandatory for central and state government employees, they automatically stand to gain from many benefits of the NPS. It's also easy to manage your NPS account online. Most of the features discussed in this video can be availed through the CRA websites. Additionally, you can make changes to your NPS account. For instance, you can update contact details, bank account details, nominee, password, etc. through the CRA website. Of course, the long lock-in period could be a pain point for many, but then let's not forget that NPS is a retirement product. It's natural for retirement products to have a long lock-in periods. Its long lock-in can actually be a blessing in disguise, as it prevents or at least limits the spending away of the retirement corpus on other urgent or compulsive stuff. So net, the NPS gets a thumbs up from our side. Now we hope you found this video useful, and if you did, please don't forget to like, share and subscribe. And I'll be back soon with another video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.